Welcome, everybody. Welcome, IOTA, Shimmer, Web3, Defi community out there. This is the IOTA Shimmer Discord. We are here in our general voice channel, and with us is Joe King and also Marcos from BanklessConsulting. They will be presenting an educational session around fundamentals of DeFi lending and borrowing platforms. And I'm really happy. This is our session number 3 in this education session. And it's really great knowledge that is being transferred into our community. And so I'll give it over to Joe now. And we are really curious to learn what you have offered for us today. And of everybody else, I said, just mute yourself so we will not have so much background noises. Okay? Joe, go.
Well, thank you so much for the introduction, and thank you so much for having me back again to IOTA community. It's been fun working with you guys last time on the grants project, and I'm excited to come back again and talk to you guys about some DeFi basics. But yeah, I'm Joe King. I'm with BanklessConsulting. I fell down the crypto rabbit hole back in 2016, as usually as an investor and doing technical analysis trading. And then 2020, DeFi summer kicked off, and I just fell in love. I think DeFi is super cool, and this is one of my favorite subjects to talk about. So thanks for having me, and let's do this thing. You've had some sessions before, you've seen them, you've heard them, and we're going to have some more. So today's tasty content, we're going to be going over 3 different lending and borrowing platforms, as well as the basics of how they work. I chose all 3 of these because they do the same thing but differently. So we're going to show you 3 different modalities to go through and use these systems. So we have Aave, which is a money market fund. Very simple, one of the most trusted DeFi primitives, large investors like Mark Cuban, A16Z. Then we have Maker, which is the very original DeFi protocol. They have the DAI stablecoin, and they invented their multi-collateral DAI vaults. And then we have Alchemix, which took this whole system to another level by having self-repaying loans and synthetic tokens. If you don't know those terms, don't worry, we're going to go through all of it together. So what is lending and borrowing? This is the simplest part of all financial systems, right? So you take your money, you give it to a bank, they pay you really bad interest, 0.01, something that's not great, and then borrowers can go ahead and borrow money from the bank. They can take a lump sum of capital, and they agree to pay it back later at a later date with interest. So think of things like mortgages, taking a 30-year loan out at 4.5%. Your bank is giving you 0.1%, and that difference between those 2 numbers is called a spread, and that's how banks make money. They're taking your money, paying you interest, loaning out to other people, getting paid more interest, and then you get paid, they get paid, and the borrower can have capital to do things like pay for university, get a car loan, mortgages. And the lending vehicles are things like CDs, certificates of deposit, treasury bills, and repos. As I talked about, very basic system. You take your money, give it to a bank. Loans go out to the borrowers pay it back with interest. The bank keeps their spread and then give you the deposit interest back, and you can withdraw your capital when you want to. So this is just the basic fundamentals of traditional lending and borrowing markets. In DeFi, it works a little bit differently. So instead of a bank, we have a DeFi lending platform and a smart contract. So on a lending side, things don't change much. You're taking your money and you're giving it to a DeFi lending protocol instead of giving it to a bank. They're going to pay you back passively with interest. Depending on the protocol, it could be 2%, it could be all the way up to 20%. In the case of Anchor Protocol, it was 20%, which was too much, but we'll get to that at a later date one day. And then on the borrowing side, and we'll get to it on the borrowing side, is a little different. Since we don't have credit scores in crypto yet, and no way to do under collateralized loans, some protocols are working on it, but it's still being toyed with. So for now, we'll just say it doesn't exist, but it will shortly. You have to deposit more money than you're borrowing. So you have to have collateral in excess of the amount you're borrowing. So say you have Ether or IOTA tokens, we're going to put $100 into a protocol. We might only be able to take out 60% value against our loan. These are called collateralization ratios. This is one of the most important parts about why DeFi is different than traditional finance. So every asset is different. When it comes to collateralization, like I said, we'll say $100 worth of IOTA tokens and you want to borrow against it. The protocol might only let you take 80% of that value back. So $100, I can borrow $80 against my collateral. Some are 60, some are 50, some are 40. It depends on the collateral you're posting. and it depends on the protocol's parameters. These are risk parameters set by the protocols to protect themselves. Now, why would you want to do this? Why would I want to put $100 into some protocol just to borrow $50? Well, the answers are liquidity. You might need cash short term. Say I think that the IOTA token is going to go 5x in the next 2 years, but I want some money now because I have to pay my bills. I lost my job. Well, I can go ahead and post that collateral, borrow money, and pay my bills, and I still own the underlying IOTA tokens. So as that continues to increase in value, my value of my tokens continues to go. I never had to sell them, but I had cash to get me through a short-term emergency. There's also tax implications. Here in the U.S., it's 22% for short-term capital gains taxes on a federal level. So it's cheaper a lot of times to go ahead and borrow money against your collateral if you need it rather than to sell it. If you look at the tax payments of 22% versus 3.5% interest, well, I can borrow money for 7 years until I've actually meeting that tax threshold. So it's a beneficial part. This is how a lot of the ultra wealthy in the world operate. They borrow money against their collateral assets like stocks and houses to get cash to use for day-to-day expenses like champagne and yachts. Then you have diversification. This is another great option. So say again, I think IOTA is going to 10x in 5 years. Well, I can go ahead and borrow money against it to use that cash to buy, say, Ether, to play the merge trade. The merge is happening. I think Ether is going to go crazy for 6 months. Well, I can borrow against my long-term holdings to buy something in the more short term. Hopefully, when I'm done, I have sold my Ether, I've made money, I repay my loan back, I get my IOTA back out of the collateral vault, and now I have more money, my assets are worth more, and I won across the board. Then the last one is the degenerate play. The degen play is interesting because it's a way for you to get leverage. So if I can take $100 of IOTA tokens, borrow $80 against it, I can then buy more IOTA tokens, lock up more IOTA tokens in this protocol, then borrow more money and buy more IOTA tokens, and continue this play all the way down until I have no money left to borrow. And I basically levered my assets up 9 to 10x where they were. There was a program invented by Daniel Siesta over at Wonderland Finance that was doing this automated for a while, where you could literally wrap your UST token over and over and over and over again until you ended up at a 99% leverage. So if the price ever dropped by a penny, you were liquidated. But these are some of the reasons why you'd want to over collateralize a loan. So how does the DeFi system work versus traditional banks? As we talked about, it just goes through the bank, a lender, then there's a borrower, and the banks are facilitating this transaction. With DeFi, we're doing it the exact same way, except we're using code and smart contracts instead of going through a bank. It hasn't changed the system at all. We've just changed the modality of how we're using it. And the pros of DeFi are there's permissionless. No one's there to tell you can or cannot use this system. It is available to everybody, open to all, and equality. This is one of my favorite parts about DeFi is that a lot over the world, bankers have been unbelievably biased towards genders, races, religions, depending on where in the world you live. With DeFi, there's none of that. It's just code. There's no one there to tell you can or cannot do it. So as long as you have the funds, you can borrow it. Doesn't matter what country you're from, the color of your skin, or the religion, you are good to go. It's fast. These loans are done at block speed. So minute and a half, 2 minutes, 3 minutes, depending on the blockchain you're using. And it's available. It's open 24/7. Good luck going to your bank on a Saturday and getting a loan. It's not going to happen. Your bank is closed. They're not going to be there for you. And the speed is really important too, because if you, I've recently bought a house and it took me 6 weeks to get financing for it, despite having all of my forms filled out and being a good credit lender. It still took a long time. These loans come through so quick and they're incredible. And they're transparent. We can look on the Block Explorer and we can see who is borrowing in the sense of a wallet address, and we can see what protocols have leverage. How much money have they lent? How much money are they holding in their vaults? Is it protected, and can I trust this protocol to not go under and lose my money? And we talked about it as well. It's tax advantageous. Sometimes it's cheaper to borrow money than it is to sell it and use the cash. Well, there's cons too. Smart contract risk. Since it's code, it's susceptible to hacks. You probably see it on Twitter all the time or in other parts of crypto news. Lending and borrowing protocols have gotten hacked a lot. Contracts can be hacked, money can be drained, and you can lose it. So a lot of these protocols have to pay a higher amount of interest to justify the risk you're taking from the technological side of things. It's over collateralized. That's also a big con. Kind of hard to buy a house if you have to put up twice the value of the home you're buying. Most people don't have that kind of capital. If you're trying to start a small business, most people don't have enough money. That's why they're trying to borrow money to do it. Variable rates, a lot of times in DeFi, the borrowing rates are changing based on an algorithm. So whether it's underutilized pool, it might have cheap interest rates, or if everybody wants to borrow that asset, then it might be really expensive to do so. Now, I wrote next to this majority of DeFi because some protocols do have fixed borrowing and lending rates, but they're usually more expensive and they're harder to come by. As we talked about with liquidations, they're also fast and 24/7. It's really easy to also lose your money in case the market is very volatile. And then a lot of these DeFi protocols have what's called stability fees, and they basically are just a loan origination fee. It's the same thing a bank calls it when you take out a credit card or a loan for a business or for a mortgage. So it's the same thing. So the cons are we are still taking some of these old world traditional finance techniques and fees, and they are getting rolled into DeFi as well. Just want to stop here and open up the floor to any questions. Those are the bare bones basics we just covered. We're going to go through in the next 3 examples and walk through these protocols and show you how they work and how these different fundamentals come into play. But I want to open up the floor to any questions about this before we keep going.
Yes, people. Anybody got any question? I see somebody writing something in the chat. Okay. Here is one question from Andariel. How are DeFi protocols are getting the market price of the assets?
That's a fabulous question. Great job. This is called price oracles. And there's a lot of debate about a lot of different price oracles. Chainlink is the number one across all of DeFi that different protocols use. But I work with MakerDAO a lot, and MakerDAO has multiple streams of price oracles, and we choose which ones to use, and we aggregate them together to make sure we're not getting an improper price. Say if Chainlink got hacked, which is what runs most of DeFi, and all of a sudden the price of Ether went from 1,400 to 800 because there was a mistake in how the price oracle was feeding, it would liquidate all these people because it's all automatic through code. So price oracles are really important in how you use them, and any protocol you use, I would definitely recommend you check where they're getting their pricing oracle from and make sure they're using more than one source. Hope it answered your question.
Maybe just to add, I think the Chainlink thing is something like you have a similar thing. You have like a distributed network of providers that basically aggregate this price for Chainlink. So you're never trusting only one source that basically says, okay, I'm looking at the price at Coinbase for ETH. Otherwise, they aggregate it from different markets and deliver these over decentralized distributed network to all DeFi protocols.
Correct.
Yeah. Then Andy has a question here. Is there a solution to the over-collateralized requirement?
So people are working on this, right? So with DeFi, we're working on the blockchain. We don't have credit scores like we do in most countries. So there are a couple different people like Goldfinch, Maple Finance, who are currently working on different ways of doing under collateralized lending. And there are some even collateralization lending as well. So there are other options. The market's trying to figure it out. A couple proposals that have been put forth and ideas being kicked around. One is kind of like a on-chain credit score. So the more times you lend and borrow for platforms, the more the score goes up based on your wallet address. So it would be like a credit score, but be attached to your wallet. There's also social consensus, where a lending and borrowing pool might only let vetted members invite people in. So say Marcus lets me into his lending pool and I borrow some money and don't pay it back. Well, then not only would I be barred from the platform, Marcus's credit would take a hit because he brought somebody in that was untrustworthy. So this is another social consensus layer that would work as well. So there's other ideas being kicked around. It'll be a really interesting space to watch next couple of years and see how it develops.
Okay, and there's just
another question.
Yeah, wanna go? Yeah.
What does actually trigger these liquidations? Because I assume it's an Ethereum smart contract, right?
Correct. Yes. So it's the price oracle triggering a liquidation. So when you take your loan out, we'll cover that in the maker section in a minute about exactly how they get the price feed and then how it get liquidated.
Yeah, because to trigger these liquidations, someone would have to call the smart contract. Obviously, it can't self-call.
Yes.
Okay.
And Budini, I like your question. That is solid. You are correct. My entire thesis in the beginning about how banks work is wrong because of the Federal Reserve and the World Bank and how people print and make credit. But to make the system easier, we're just going to say that's how it works because that's how it's supposed to work. And that is a great observation if you know the inner workings of how modern monetary theory works.
Okay, cool. Maybe
All right.
we go on to the next one, huh?
Sounds great.
Yep.
All right, so our first demo today is going to be about Aave. And Aave is one of the oldest, most trusted DeFi primitives. It was created in 2017 as a protocol called Etherlend. And for numerous iterations and mistakes and problems and trying to figure out how to get this whole system to work, they rebranded as Aave in 2020 and were one of the first catalysts to DeFi summer. I personally learned for myself during the research for this presentation is that Aave is the Finnish word for ghost. And that whole term is there to say it's transparent, but it's also anonymous, hence the ghost. And with the core features of the protocol, it's a money market lending platform. So you can lend to this protocol and you can borrow it. It's peer-to-peer lending facilitated by a smart contract, and the loan rates are calculated algorithmically. So based on the demand for a certain asset, the prices are going to change. I will link the docs for Aave in the Discord and show you guys. There's a lot of math equations in there that show you how the algorithm is done, and it's some pretty elegant math, which I think is pretty cool. There's no fixed date to return the capital. The interest continues to accrue. Most times when you get a loan from a traditional finance lender, it's going to be a 30-year fixed mortgage or a 5-year fixed business loan. When it comes to Aave, you can borrow for as long as you want to. You're just going to keep paying the interest until you pay back the principal. And it's on a lot of different smart contract chains. All right, now forgive me for a second while this video loads and we pop this up. I pre-recorded these so I didn't mess them up live.
All right, welcome.
Can everybody hear that?
Yeah.
This is your dashboard showing you the overview of the Aave system, talking about supplying, staking, borrowing, and using your Aave governance tokens to vote in protocol. At the time of recording, there's just shy of $10 billion locked into Aave across all 7 networks for 13 markets. They currently operate in Ethereum, Avalanche, Optimism, Polygon, Arbitrum, and they have their own Aave Arc, which is like a private Aave for DeFi market institutions, wealth managers, and private funds. Built by the community and all of the fun ecosystem things you come to expect with DAOs and grant programs. All right, let's take you in. For this demonstration, I will be using the Arbitrum market. Save on those gas fees. Arbitrum's a layer 2 on top of the Ethereum main network, and this allows you to do transactions much cheaper, but they also change, right? So here, the APY for me depositing ETH is only 0.93% versus currently on the Ethereum network mainnet, that interest rate's 1.3. So the networks have their own different validator sets. So each network has their own algorithm that runs everything. So you see we're at 0.93% here on Arbitrum. Say we drop down here to Avalanche. The AV token is paying 2.5, but there is no ETH market here because it's Avalanche. Versus we go down to Optimism. We can see the ETH borrow rate is 1.3, plus they're paying out Optimism tokens, which gives you a total yield to 3.8, giving you 1.3 in ETH, and the additional value would be coming to you in Optimism tokens. Same with the borrow rates. They are different for each network, so make sure you check the networks and decide which one is right for you. We're going to use Arbitrum just because I have some ETH loaded on a wallet there, and it'll make life easier. So here's our Ether. I'm going to go ahead and supply 0.25 of an Ether to the protocol. 13 cents in gas fees. This will pop up my wallet, ask me to approve transaction that I'm supplying 0.25 ETH. I'll confirm. As the blocks will start to confirm, and we will have our supplied ETH into an Aave pool. Okay, now we've been given a token. This is the Aave version of their ETH token, which represents it being locked in their system, the synthetic token that is the Aave ETH. Add that to the wallet. And now that I have ETH here, I can borrow any of these assets against my Ether. So these are the rates that I'm paying in a variable. These are the rates you're paying in a stable. So I'll take the variable rate right now, and I will, for example, borrow some DAI. So let's go through. I'll take the variable amount. How much will it let me borrow? I can borrow 3.01. See, my health factor here goes to this, shows me. I liquidate at 0.01, so this gives me 0.013. I'm really close to liquidation ratio here if I take this much out of the vault at a time. So I'm going to make this a healthier one. We'll say $150 in DAI. Health factor is 2. If I'm double the health factor, I'm safe. So I'm going to borrow this $150 in DAI against my Aave position of the Ether I've deposited. Confirm a transaction on my wallet. Sorry, first time using this wallet today, so I'm adding all of these tokens. This is me authorizing my wallet to show me that I have the token there. Now I have DAI, so I have 0.75 Ether left in my wallet, and I have $150 back in DAI. Now, see a position here showing me I'm making 0.84 in my pool. It shows you my health factor of what my loans are, and my net worth of what's available in both all my positions. This is not my total wallet, just deposited positions and then borrowed funds. This is the plus and minus added together to show us what we have. So I'm going to repay this DAI loan, right? So I took out $150 worth of DAI. Because of fees, I actually lost 3%. So I need to actually go get some extra DAI to pay this. But if your wallet has extra, you have no problem at all. But see, the 3 cents was an issue there to repay the debt. So I'll go to repay. I'll max. Pay my $150 back, 5 cents, proving the transaction in my wallet. Every time you work with a DeFi protocol, you need to approve the assets in your wallet. This is giving your wallet, giving this protocol permission to access your wallet and to use assets in it. So I've approved my DAI, and I'm going to repay the loan. Once again, wallet transaction comes up, confirm it. And now we're repaying the DAI and the loan, clearing out my loan balance. Waiting for the transaction to clear. Pending, and now it's approved. And we're all done. We repaid our loan. Our loan is gone. We can now withdraw all of our collateral. Max. You can wrap or unwrap your ETH depending on the network you're on. There's no reason here to wrap my ETH at all, so I'm just going to have it unwrapped. Another 10 cents in transaction fees. Once again, permission given. We are approving this transaction. It is approved. We now withdraw our ETH. Confirm the transaction. Pending. Luckily, Arbitrage is very fast. Done. We are all set. You can go look at our wallet. Show our assets. We paid some gas fees. Other than that, our ETH is back into our wallet. So we refunded our ETH, and we are set.
And I'm back. Sorry. Thanks for muting me.
Yeah, no, that's great.
Actually, well explained. I liked the video. Quite good.
Well, thank you very much. I appreciate that.
Yeah, also that
There
you
we
did
go.
it on the live network and not on a test network and wasted some gas.
Sorry, you guys
Okay.
are worth it.
Just thinking because people either they just show it and then don't click on approve, or they do it on a test net. This is like the first time I saw somebody doing this on the mainnet live.
That's what I had to do for the Alchemix demo down the road. The gas fees were like $20 a transaction. I was like, oh, sorry, that's a bit too much for me. So, any questions about Aave and what features you saw? Are you guys ready to try this stuff on your own network on Shimmer? And talk to me.
Yes. Maybe the one question from my was because you had this different rates for variable or stable positions, and you explained it here in the chat, but maybe you can just give it again.
Yeah, sure. So the variable rates are based on the algorithm they have. So it's based on the usage and the supply. So how much DAI is in that pool able to be borrowed, and also how many people are trying to borrow it. So the higher that usage goes, the higher the rate is going to be. And the less availability in the pool, the higher the rate is going to be. So right now, because we're in kind of crypto winter and no one's really doing a whole lot in DeFi, rates are really cheap. So if you're going back, say, a year ago when the market was going crazy, those borrow rates were probably closer to 6 or 7% rather than 1. So in that case, that stable rate would have been much more advantageous to take versus the variable rate now is so cheap. So if you borrow that loan now, say you take $1 million out, some crazy number that you're not going to repay for a long time, that rate can change. So that 1% you have now might become 20% next year if the rates are crazy. So you have a risk when you borrow against that rate going up and down. So that stable rate you can borrow against while you're paying more upfront now, it does give you a peace of mind down the road that that price will never go up.
All right, cool. Yeah.
So I have a question about the API. So when it says 2% per year, it's probably calculated on a per block basis on how long it takes me to pay it back, right? Or how do
That is
they
correct.
calculate when? Yeah.
And then total cost of the loan I see in the chat, I think the total cost of that loan I just took out was less than $3. And that was all on just gas fees.
Cool. Yeah. Anyone else?
Now we can jump
Just
into
asking if you would have
MakerDAO.
So if
you
the risk then is for like the whole platform is if there's no liquidity and someone gets like margin called because it's done by a smart contract, right? So whatever someone's putting up for collateral, they're going to have to sell that, but then there has to be a buyer on the other end. So is the sell buy only in the platform itself, or is it like outside on other markets?
So for Aave, it's outside on other markets, but I'll show you in a second when we go through MakerDAO how Maker does it, because it's a totally different scenario. So each platform does it differently.
Okay, so but that for the user, it would be good to know basically where that's occurring to make sure that there's enough liquidity, because the risk is if that smart contract triggers and there's no buyers, then basically the whole platform just kind of the price is going to go totally whacked out at that point, and there is potential for like insolvency.
Correct. That is always an issue, but like with how deep, so this is where it comes in about asset selection. So this is why these protocols are picking what assets they're willing to lend and borrow against to make sure there's a liquidity enough to handle these liquidation events.
So let's say with Aave, is it transparent of where they're because you said they're outside the platform, so is it transparent on which locations these are occurring?
They're just on exchanges, and I wish I actually knew the answer to that question. I don't know for sure exactly if you can see where the liquidations are happening or not.
Is it centralized exchanges or other dexes or both?
I would assume since being a smart contract, it'd have to be through a DEX.
Okay, cool. Okay, cool.
Yeah, so we'll get into Maker in a second. Maker's got a whole crazy way of handling liquidations. They're their own little beast. But we can move on if you guys are ready.
Yeah.
All right. So next one we're going to go through is MakerDAO. MakerDAO is the granddaddy of DeFi, #1 protocol, first one created. It was originally theorized 2014 and actually put into practice in 2017. They are the issuers of the DAI. It's an over collateralized stablecoin. If you've used DeFi, you've probably seen DAI around. The MakerDAO is also known as the multi-collateral DAI system. It's assets approved by Maker governance, but MakerDAO uses this as built the system, and there's other front ends that access this system. So one of the goals of Maker is to just become the backbone of a lot of lending protocols. You can go to Oasis Finance, a lot of other places have Maker as their backend. They have these digital vaults tokens. Currently, they have ETH, Bitcoin, Link, Uni, a few other tokens, and some Curve LP positions. And you basically deposit them and you borrow DAI against it. Unlike Aave, there isn't a lender on the other side, right? Maker is the lender. You're giving them the collateral and they're printing DAI. So they're actually making their own liquidity. So you're not borrowing ETH, or like what we saw with Aave, you could borrow ETH, you could borrow Bitcoin, you could borrow LUSD. With Maker, you're only borrowing DAI. That's the important decision or difference between these two systems. There's two tokens in the system. There's the MKR token for governance and then the DAI stablecoin. So here's an example of how this over-collateralized vault works, as we're talking about liquidations. So say I have $300 in collateral, and I'm taking out, or allowing me to take out $185 worth of DAI. We'll go ahead and say there's always a stability fee involved. So say a stability fee and a liquidation threshold is there, we'll say at $5 combined. So in this collateral, if my Ether I put in this pool drops down to $190, they will liquidate me. I will keep my DAI, and they will sell all of my assets. And that's what happens at a liquidation there. We'll go through the auction in a second. And here is a demo of Maker.
Hello and welcome to MakerDAO. We are at makerdao.com. This is the site you'll log into when you first come through. Have little explainer videos, the usual ecosystem developers learn, foundation, community, all the fun things. Come down here, we explain what DAI was, showing you about the fact that it's a $peg stablecoin. You can read the white paper here. Decentralized governance, learn all about MakerDAO's governance structures, the core operating units, how we onboard new assets, how stability fees are set, lots of information, and the growing ecosystem of all the different dApps that are currently supporting DAI, wallets, and different CDP positions inside of the Maker community. Now, let's use DAI. This is going to take us to Oasis app. This is an app that is being used to actually take over and move everything through the MakerDAO DAI positions. See all the products you can borrow against your assets. Shows the daily volume. There's currently $3 billion in Oasis. Median vault size is $118,000. And you can trade, you can earn, and you can borrow on Oasis. But we're just going to worry about borrowing today. There are many positions you can borrow against. You can see all of the different products here. ETH, Bitcoin, DAI, the UniLP positions, and the Efi tokens. This is interesting. By using a Uniswap V2 position, you can take your DAI USDC or USDC ETH LP position, which is currently gaining swap fees, and you can borrow against those positions. So you're earning yield and you're borrowing against your yield generation. This is a really interesting way of handling how you can borrow against positions. So this is very similar to the traditional financial system of being able to borrow against your assets that are currently already earning you yield. Let's go ahead and take a look at traditional vaults here. Ether is the first product and still is the most popular one on. Collateralization ratio is 170%. There is $95 million of available liquidity to borrow, and the current fee is only 0.5% to borrow, which is pretty cool. But there are some other fees, including one I go through about the stability fee and other things. So the other fees that are included are the stability fee. This is what Maker charges to generate these vaults. This changes based on the algorithmic need. So how many people are generating DAI from vaults and how many people are repaying them. So currently it's at 0.5, but this will fluctuate. This is the important fee, right? So 13%. This is a $100,000 position. If I got liquidated, they would be charging me $13,000 to be liquidated. So you really don't want to get liquidated. It's very expensive. It's expensive for MakerDAO to execute the liquidations. That's why they charge you this fee. But because of this, you want to make sure you withdraw your vault before it gets liquidated. You can pay the DAI back. You can add more collateral. There's plenty of ways to not get liquidated. But it's important to make sure that you're not getting this done. If you do, you're going to pay the amount you owe plus 13% on top of your collateral. So it's a really bad hit. So while I don't have 50 ETH in my wallet currently, we will at least show what it looks like. So this would be a $75,000 USD position, allowing me to generate up to $44,000 in DAI. What does this look like? So let's take it to the max. Let's say we're actually going to borrow the $44,000 worth of DAI that they offer. So 171 collateralization ratio means that the price dropped down to $14.96, which is pretty close to what it is today. I will be liquidated. The DAI debt value available to withdraw and be able to generate. Meaning as I pay back this DAI in this vault, I'm able to withdraw more of my Ether from it. So let's take it down to 5,000 again and show what that looks like. This would look like I could take 44 ETH out of this pool to keep my collateralization ratio going. and I could generate an additional 39,000 DAI if I want to. So you don't need to take out the full value of the position. This vault will be open, and you can put money back into the vault, and you can withdraw more money from the vault depending on how these changes. If ETH's price goes really high, say it goes from that 15,000 or 1,500 today, if it went from that to 3,000, I could double the amount of DAI I could borrow. It's just based on the dollar amount. But if ETH were to drop 50%, I would get liquidated because that price would hit. Right, so right now with this only 5,000 against 75,000, ETH would have to go to 170 for me to get liquidated. Let's make this 15,000. ETH had to hit 510 for me to get liquidated. So you can top up these vaults and withdraw from them if you want to. And that is what a MakerDAO vault looks like. Remember, you can add, subtract collateral. You can have this as a living, breathing smart contract where you can continue to mess with it by adding assets, removing assets, and changing the ratios as you're going through. You're only paying the stability fee and the interest rate, which is low. So the interest rates are now pretty low on everything on MakerDAO, which is pretty awesome. So it's cheap to borrow. As long as you don't get liquidated, life is really good. Well, I hope you enjoyed your look at MakerDAO.
Sorry, I talked a little fast in that video, so I want to make sure we have time to kind of cover everything in there. So if you have any questions, please fire away before I get into liquidations.
Low.
Okay, let me look. No, in the chat is nothing. Just for me, just to make it clear, that's the thing. Is like everything in MakerDAO is basically based on and focusing on creating the DAI stablecoin with the assets that you basically deposit in it. Yeah, and so that's kind of the central thing in the whole system is that basically the DAI flow is guaranteed by the deposits of the users, and you really have this DAI as the underlying asset on anything, and not like in Aave that you really can take out other coins and basically would then start trading with them or things like this. This is basically really for you also to have your positions in DAI and in a stable coin then, yeah.
Correct, exactly. So it's the whole thing is based on DAI, and they're just your assets are backing it. So DAI itself is over collateralized by other crypto assets.
Yeah.
I think I have missed something, but what exactly would be my incentive to say that send 10 ETH into that smart contract and borrow some DAI?
So it's the same
Because
as we go back. Here, let me go pop the slide back one. There we go. It's gonna do it. There we go. So just like over collateralizing the loans, right? Like you might need liquidity. So say you have a ton of ETH and you say you lost your job and rent is due, but ETH is down 50% and you don't want to sell it right now. You can borrow against that ETH, take that DAI, withdraw it into your bank account and pay your bills. You might just want to have some capital to buy other assets. Yeah, so all different ways you can over collateralize a loan, and that DAI could be put to work in other places. A big one too is arbitrage. So that DAI right on that loan we're looking at less than a 1% fee at the moment because it's so underutilized to borrow DAI. You might be able to find a protocol like Nexo or other or other borrowing platforms where you could deposit that DAI and make a 5 to 6% return. So if that's the case, you're only paying 1% to borrow DAI, and they're paying you 5% to stake your DAI in another protocol. So this is a way for you to arbitrage yield.
Yeah. So where do these 0.5% of fee go? So my interest, because there, if I got it right, there's not a lender on the other side because the DAI are created, right?
It is going back to MakerDAO. So the MKR governance holders, so MakerDAO actually has a really robust payroll. There's a bunch of different they call them core units that operate inside, and those core units, one of them is handling price oracle feeds and what assets are listed. There's another core unit that's governance, just taking care of the system because it's a DAO, has to be managed. There's delegates. So basically all these fees go back to pay all the operating expenses for Maker. All right, so let's dig through liquidations for a second about how Maker does this. Oh, sorry.
One question. So if you have, let's say, ETH in there and ETH appreciates over that time. So all of a sudden, your ETH goes from costing 1,500 to 3,000, and you take out DAI against your ETH, and then you repay it. Are you able to basically take out a loan that it gets repaid by your exit because of the appreciation of the collateral?
In MakerDAO, you can't. We'll cover Alchemics next, and with Alchemics, you can do that. But if, say, your ETH goes from 1,500 to 3,000, nothing changes. You just owe Maker back the DAI you borrowed. So if you only say you put $3,000 worth of collateral in, you borrowed 2,000 in DAI, and now your ETH is worth 6,000, you only have to pay back that $2,000 worth of DAI you borrowed the first time.
Okay. Okay, that makes sense.
Yeah, so liquidations in the Maker system are a little bit different than other systems because it's not 100% done by a smart contract. There's a third-party actor played called a keeper. What happens is, say your vault, in this case you just mentioned, you have $1,000 worth of ETH locked up, you borrowed $800, but now ETH is at 800. You are insolvent. Your loan is below threshold. So what happens is it goes to a liquidation auction, and there are actors out there who are bidding on your collateral. So usually they're trying to buy your collateral for a percentage or two less than it's worth. That way they can make the spread. So they can go ahead and take that $1,000, they'll buy it for $9,900, for $990, and they'll make the $10 on the thing. This used to be done by people, but now due to block speed and flash bots, this is all done by bots. So algorithms are usually bidding on this collateral, trying to figure it out. Who can make the most money off of it and how high it needs to go. So once that bid is placed and someone's buying your collateral, one of three things happens. So we'll go to the bottom since it's the fastest, and we'll go upwards. So case 3 is the best case scenario. My $1,000 worth of ETH, $1,000 worth of ETH, and I have $800 worth of DAI. It gets liquidated for $990 worth. They pay back my $800 that I owe, and that extra $190 that's there, they refund $190 worth of Ether back to me. So I get a little bit of my collateral back because they were able to get the whole loan paid back, and I get to keep the difference, minus the liquidation fee. Then in case 2, the vault is solvent, the DAI is paid, Maker gets their money back, and there's nothing left over. So I get to keep the DAI that I borrowed, but my Ether is gone now. That's the risk you take when you get liquidated. And then case 1 is the worst case scenario, which is the vault is bankrupt and they can't get an auction price high enough to pay for the collateral back. So there's two systems that happen, right? So in case 1B, we've had a few examples of this. Black Thursday during the COVID crash, as well as in 2018. We call it the flash crash of 2018. These two systems happened, and Maker had to print more governance tokens. So the MKR token, more were printed, which means it dilutes the token holders. So the governance body of Maker is being punished right now for either doing something bad, either the thresholds were wrong, or the collateral we were accepting was wrong. So our token price that we hold as governance holders are now worth less because there's more on the market, and Maker is selling their own governance token for DAI to pay back these loans and keep the system solvent. This hurts governance holders, but the system remains, and DAI keeps working and there's no problems. When it comes to case 1A, we've never had a problem with this before, but this is called a doom loop or a liquidation cascade. This happens where we keep printing Maker tokens. We try to buy DAI to keep paying back these vaults. As these vaults keep going bankrupt, these wave of liquidations happens. We keep printing Maker. The Maker token keeps falling in value. Nobody thinks it has any value. Everybody begins to dump their DAI, dump their Maker, and the whole system implodes, and MakerDAO is done. Luckily, that's never happened before, despite all the market volatility in the last 5 years. But that is always a risk you take when smart contracts with a system of over-collateralized crypto assets. I'm going to leave this up for a second for questions. This is a complicated topic.
So you had 170% collateral, then it liquidates. That was the minimum collateralization, right?
Yes.
So and still, despite 170%, you didn't manage to get back the entire value.
In case 3, yeah, we keep our DAI and we get a little bit of assets that are left over. And in case 2, we keep our DAI and all of our collateral, our ETH is gone.
I really
So
answered
and
your
in
question.
case 1, I'm talking about case 1B. So that really 170% was not enough, or was that increased back then?
No, we'll say it wasn't enough. So say, in the flash crash example that I talked about in 2018, ETH dropped from $1,400 to $600 in a day. So that quick of a price drop, all those vault thresholds are getting triggered really quickly, and the system can't keep up with how fast liquidations are happening. So liquidations are happening,
okay.
it's printing maker, and this doom loop, and the price starts to drop.
I just really like
Okay,
how
so these auctions could not be fulfilled quick enough, essentially.
Exactly. And they were trying to sell the assets on the market, which the market was already crashing. And now you're selling all this ether into the market to buy DAI back to repay the loan. So you're speeding up the price depreciation because all these things are hitting the market at once.
Okay, now I'm understanding. Because I was a little bit confused because prices did not drop that hard, but of course, if there's no liquidity available to fulfill your sales on the chain itself, because, for example, arbitrage bots are running low in liquidity and would have to wait for a centralized exchange to resupply, then you have a problem.
Exactly. That's one of the reasons why Maker governance is so incentivized to make sure that we're onboarding quality assets that aren't going to change in price drastically. But of course, it happens sometimes. Market volatility is always a danger for all smart contracts.
Yeah, especially because, I mean, where are you pulling your liquidity data? Mostly from centralized and decentralized, but also decentralized exchanges, I guess, right?
Yeah, price oracles. Kind of like the
Okay.
Chainlink example we talked about earlier.
Yeah, but I would have to look where exactly they are pulling data because of course, there's, for example, centralized exchanges with really low liquidity where a whale fat fingering can drop the price to near zero.
And that's why they use aggregators. So most of these price oracles are fed with multiple price oracles. It's not just Coinbase.
Yeah.
It could be Coinbase, Binance, Uniswap, a bunch of different dexes and centralized exchanges. All right. Well, let's keep on trucking. We just covered questions, so we're running out of time. I'll try to get through Alchemix real quick so we can cover this and have questions at the end too. But Alchemix is the third version of how we do this lending and borrowing platform. They invented the self-repaying loan, which is kind of a crazy concept in finance. Same thing. It's an over-collateralized borrowing platform, just like Maker is. They're also a lending protocol. They have vaults and farms. These are different yield strategies. So ways to make money, how they're deploying assets to make interest on it. Just like Aave we talked about a little bit, they have synthetic assets where they're making their own tokens, which we'll show you in a second. And instead of paying interest, you don't pay interest on these loans. You're actually getting paid interest to take the loan. And same thing, no fixed date to return the capital. Interest continues to occur. This is how it actually self-pays. And the debt ceilings fluctuate how much you can borrow at a time. Just like we talked about with the price feed, it's variable. So depending on how many people are using it, how the utilization ratio is how the debt ceilings can fluctuate. So how does a self-repaying loan work? Well, they have these strategies that pay different amounts of interest for different crypto assets, and you deposit your assets into this yield strategy. We'll say it's paying you 2%. And you can borrow money. You get 50% of the value of the deposited assets. So when you borrow capital, you're getting paid in a synthetic. We'll cover in the next slide. So you can get USD or ETH, and then you wait. So this yield strategy will slowly repay the loan. But the catch with this system is it's only repaying the amount that's in the vault. So if I put $100 in and I borrow $50 out, I'm actually only getting paid interest on half of my deposit because I borrowed the other half out of the pool. So at 1% interest, it would take you 100 years. With compounding, it's less than 100, but we'll just say 100 to make the math easy. Or 200 years if I borrowed half of the value of the loan out. The withdrawal feature on Alchemix is really cool because you can withdraw when the interest loan has repaid itself. You can repay your debt yourself to remove, or unlike Makers you talked about, you can self-liquidate. There's a button you can hit to just close your loan out. It'll sell your collateral to the amount you borrowed, and you'll get all your collateral back again. So you can self-liquidate the loan. So real quick, we'll go through a synthetic asset. It's a tokenized derivative. Essentially, we take ETH, and then Alchemix takes your ETH, and they issue you an ALETH token that is backed by them. So it's just a way of saying that this token is locked in Alchemix, just like staked ETH or RT, Rocket Pool ETH. It's just another way of saying that, hey, this person has my ETH, and I can borrow and trade against the value because you, as the borrower, know that ALETH can always be swapped back to a regular ETH. But it's a way of keeping track of what's in the system and how to take money out. The real world uses a lot of derivatives. If you look at the stock market, there's derivative products everywhere, and they're really complicated. Where if you're not really a PhD in mathematics, you probably have a hard time understanding what a derivative actually is. But luckily on the blockchain, they're all transparent. We can see who has them, who's issuing them, where they're going, and this transparent system allows us to have safety. There's been a lot of concern in the regular financial markets that these derivatives could eventually blow up the entire global financial system, which is pretty scary. So the important part about this system is that the crypto synthetic asset can be used in yield farming, and this is how this system actually works. Should be a fast demo on Alchemix.
Welcome to alchemix.fi. This is our self-repaying loan platform. On the first landing page here, we'll take you through a little video of how the process works, show you what we just talked about, which is depositing, earning, you can borrow, spend, and save, leveraging your assets, benefits of Alchemix, and the typical fun stuff, all the social medias, Discord, and how to get involved. But what we care about today is the vaults. This is where the magic happens. Vaults are where you can deposit and you can borrow your funds. So what we need to do is first pick a strategy we want to deploy our funds to. So you can see right now the APYs are not very attractive due to the underutilization of DeFi right now during our current crypto winter. The good rates down below are with Lido and Rocket, staked and wrap staked ETH, paying 5%, 1.39, but as you can see, these vaults are full and they have no capacity to add any more funds to them. Other funds are open, different spots. Okay, so we're here in the Aave and AUSD pool. You can deposit AUSD, which is Aave's USDC token, or regular USDC. So we'll use regular. I'll take $40, deposit it into the vault. Again, every time you interact with a new DeFi protocol, you're going to need to approve a token, confirm. Your ETH or Yearn or any other token you've deposited had made enough money as well, so you were made money off of the loan itself and your assets were worth more. So the best part about this system is that it's not liquidatable, right? There's no liquidation threshold. There's no way for you to have your position destroyed without your permission. So the benefit of Alchemix is no liquidations, safety and protection, a little bit slower, and also no interest, right? I'm not paying interest to borrow any of this. I'm actually getting paid interest to borrow money. So Alchemix is a very different style of lending and borrowing platform. So I hope you enjoyed your look at Alchemix.
Okay, great, great. Um, I don't know. I just dropped out for 30 seconds, so there's 30 seconds missing on the video, but it's cool. So anybody got some questions here?
No questions, but comments. Thank you very much for the nice 2008 flashback and the mortgage-backed securities. Thank you.
No problem.
So, of course, whenever I see an APY, the question is, where does the money come from? Because if that's a bit shady, then it's BitConnect 3.0.
Absolutely, and that's kind of the issue right now with a lot of these lending and borrowing protocols is that the yields on they were arbitrary. They were basically using the other DeFi protocols. So if Alchemix is taking money or Aave is taking money, they might be deploying it in a different yield farming strategy to make more money than they're actually paying out. And that was Alchemix's main business. But now that interest rates are so low across DeFi, that's why you see things like 0.3% interest. And no offense, you can get better money at a bank than that, as well as you're also taking added risk of having a smart contract hack. So you're taking smart contract risk and you have your actual loan amount. So if you can make more money in a safer way, you should. That's the thing. But the cool part is if you want to borrow money with Alchemix, there is no liquidation. So even if you put ETH in there all the way up and ETH drops by 90%, you're not going to get liquidated. You keep your collateral as there. So it's a safe way of taking loans out and not worrying about the price volatility.
Yeah, I
But
think
still,
it's,
that would crash the vault. The vault would then be less worth than the stuff paid out, for example.
Yeah, but to remember, you're only borrowing their synthetic tokens. So if Alchemix goes down because the price drops so hard, your synthetic tokens aren't worth anything either. So that's the risk you
Okay.
take. If the market completely crashes and goes apart, Alchemix itself could be insolvent, and if that happens, your synthetic tokens can never be redeemed for the real underlying tokens. That's the risk.
Okay. I guess there might be a premium selling LETH to main ETH for example.
Absolutely, just like staked ETH and RETH, which we've been seeing since the merge, same thing. You can buy a staked ETH for 4 or 5% off the price of real ETH because there's no redemption right now for it. So you pay a little bit of a brisk premium for that.
yeah, it's interesting. And like it'd be nice to see some case studies of DeFi lending platforms that did well during the bear market and that got caught during the bear market because it's it seems something like because there were DeFi platforms putting money on Celsius, right, to get a return, but all of a sudden it goes insolvent, so they get hammered, and I'm sure other DeFi platforms, again, like you said, they're taking deposits and spreading it out for a better return, but then where are they spreading it? Are they transparent about that? So, even like the mortgage crisis, if they were to say just transparent, where everyone could see that, holy shit, they don't have money to cover any of this, it's just a pyramid of cards, the outcome would have been a little different because then people could see. So, I just hope that, over time, I think it's amazing. I mean, at least in America, the whole credit system really keeps a lot of people down. But if there was a safe place that could get where they don't need pseudo credit or it's just more, kind of like you said, on-chain credit analysis. Um, but again, the only thing I could see that working is just pure transparency of where is those funds that are paying back the people that are, putting in, and are they in safe locations? But of course, that's all hard to judge in risk management.
Well, luckily, with the benefit of DeFi is that it's all transparent, right? So it's on the blockchain. If a DeFi protocol is investing funds somewhere, you can use a block explorer to see. The problem we had during the last crash was places like Three Arrows Capital or BlockFi or Nexo or Celsius. Hodl all these companies that blew up, they're actually central lenders. They're a black box. So once you deposit money into them, you don't know what they're doing with it. There's no on-chain tracking. They're just like a bank. They call them shadow banks who are doing this. So they're putting money in places that you have no idea. And that's what happened. Three Arrows Capital borrowed so much money from so many different people. And because there was no checks and balances system, they were able to lever up 1.8 billion into 10 billion, like some insane level of leverage that ended up blowing the whole system up. But with DeFi, if they're putting something somewhere, you can track their wallets and see what strategies they're doing. And Dune Analytics has a dashboard on this too.
Who is that? What analytics?
Dune Analytics.
Dune Analytics. I'm gonna put that on the website. Put it in the chat.
They're one of the best public goods in blockchain. They're incredible.
Yeah,
Okay.
you find all information on that. Yeah, and that's the cool thing, really. You can just really follow through the block explorer. I mean, you will just get an address, but you can, again, do your research and figure out where this address is belonging to. And so you can, if you put in the work to do your own research, you can actually figure out what's happening in the back of all these things and could then estimate, are you willing to take this risk, even if you see that Alchemix
We're past time, but I'm happy to hang out and answer questions for as long as you guys want to chat.
Yeah.
But well, I'll have to say though, it's again, I think like, it's all markets, right? It's like, yes, everything's clear on chain, but sometimes it's kind of, like, okay, so Dalby did they're doing like a DeFi platform and they have a test one. And on their dashboard, it says, hey, there's $24,000 TVL. And then, but the link to the on-chain wallet isn't there. You have to kind of go in the FAQ and then you got to find it. But then there was only half the value, which made sense because they said, well, we hold half the value in USDT and then we hold the other half of the value in IOTA. But they hadn't put their IOTA wallet. So in that sense, it's kind of like semi-centralized because since there's not smart contracts yet, they are essentially centralized custodying the IOTA. But it's just, I think, especially if there's an influx, like if Shimmer Network and there's a lot of DeFi, it's like, yes, it's all on chain, but sometimes you really got to be educated to know either A, how to look for it, B, how to read it, and then C, if it's not there, how to ask for it. But, more education, the better. And again, I hope that the DeFi platforms that make it easy for the uneducated users to see and trust, and that are transparent, then, hopefully get more users and that becomes, the norm over time. And just
Absolutely.
on Dalby, by the way, they did put their IOTA wallet into the FAQ now, so it is transparent, but they just simply forgot apparently at first.
I mean, and yeah, there was like still not fully smart contract based, but the interesting thing I think for our community is these are big names here, of course, but the kind of cool part, but also the is that the lending platforms and also the decentralized exchange that will launch on Shimmer most of them will be clean forks of these systems. That doesn't mean that they're automatically as secure or as risky, but basically they just use the exact code. Yeah, but of course it depends also. Like MakerDAO, it's something that I really think, Joe, it's very, very difficult to just fork and clone because MakerDAO very, very much relies also on the backing of the community and on the maker token and everything that is in the back. Yeah. So, but I think as far as I know, we will have an Alchemix clone going live with us and also an Aave fork. So basically, you have this proven systems that will work exactly as Aave does, as long as they have done a clean fork. But then basically it depends on the teams that operate and that set up these things to make them work really as good as that. And then it depends on the liquidity on the rest of the market, because even an Aave fork or something without a proper structure of deposits and landed assets and without liquidity, it just will not work as expected. Yeah.
Very cool.
Do we have more questions in the audience or somebody in the chat or something? Okay, we have a question here. Is there an overview which DeFi projects are launching on Shimmer? Yes, you can look into the Shimmer ecosystem website. So basically, these are the ones that are there's a website where people can register their projects that will launch on Shimmer. Not yet when, but you will find the links, and then you can follow through and read up what they are doing, how they plan to work. And basically, I'm putting the link up here, and you can look this up. Yeah, thank you, Herbert.
Well, awesome, guys. Thanks so much for having me. I appreciate being back and getting to talk to you guys again. Hopefully, I spoke a little slower this time. I know I talk a little fast, and that was a comment I got last presentation. So
yeah, it was really great, Joe. It was really, really thanks a lot. I think everybody should have learned a lot about these things. Great presentation, great overview, 3 different interesting programs. Also really nice to go into this a little bit the back and the financial systems and all the things that hang together, and the comparison to the traditional old system was really, really valuable. And I think it was very, very good for our community to really understand more what this lending and borrowing actually means, and what basically also maybe the advantages and also the disadvantages of DeFi lending and borrowing platforms will be, and how we can try to safely navigate these new opportunities for us.
absolutely. If we're going to create a new system on the blockchain, which I know we're all working together every day in our own way in Web3 to make a new, transparent, better working financial system, it's important to know the old system, what they did right, what they did wrong, so we can bring the good stuff with us and leave the garbage behind.
These are great closing words, Joe. We all will agree on that and work on this together. Great. Thanks, everyone. If there are more questions, you can still use the general chat or something and can continue chatting. Joe, thanks a lot. Marcus, also thanks a lot. Again, BanklessConsulting, great content that you provided with us. One thing, next week, we will have all the big launch for Shimmer Network. So next week, we will not have education session because there's too much stuff going on in IOTA and in the Discord and in the Shimmer. And then basically, I think it will just go under all the announcements and all the things. So the next DeFi education session will be in 2 weeks from now. We will update you on the exact timing over the Shimmer Twitter account and also over the event announcements here in the Discord. Thanks a lot. This video will be uploaded to the IOTA YouTube channel, and in very likely a couple of hours, or in 5-6 hours, I'll put it live. And then those of you that have missed the beginning, you can all rewatch it in the IOTA YouTube channel. Also, the other sessions that have taken place already are available on our YouTube channel. So drop in there and you will find all the information. Thanks a lot, everybody, and have a nice evening, have a good afternoon, and see you in 2 weeks for more education.
Yeah, thanks again.
Thank you.
Alrighty, bye-bye.
Thank you. Bye-bye.
Fido?
Yeah?
Fido?